Hello, Forex Empress here. I trust you've been doing great. So, in our last video, we talked about the different kinds of orders for entering trades for a beginner or for anybody at all. If you've been trading for a long time, then you already know this. But if you're new, then this is some good information. So we talked about the markets and instant execution, how you enter the market at the current market price like you have here. Then we're talking about the pending orders. So we'll discuss the different types of pending orders. The first one we'll discuss is the buy stop. Now when you place a buy trade, for example, you're predicting that the market is going to go up. Okay, so for example, you feel this current price for your buy stop, for example, you feel that this current price is not a price you want to buy at because you feel the market hasn't crossed a certain place for you to click on a buy. So let's say you're waiting for price to, now there are different reasons why that will be. You might say, okay, I want price to break this level. First of all, let me use a brighter color, yellow. Okay, so you might think that I want price to break or to open and close above this price 1,735.49 before I buy. So you're saying when price breaks this level, then I'll be sure that price is going up. So what you can do is you can say I want to place a buy stop because now you're predicting that the market is going to go up. Okay, you're predicting that the market is going to go up. Let's move this bit. So maybe you're predicting that the market is going to go up this way, up to this level. Okay, yeah, and you want to make sure that this level here has been broken before your trade is activated. What you can do is to place a buy stop. So what a buy stop does is it buys above the current price. Note, your buy stop buys above the current price. That is a buy stop for you. Buy stop is an order that is placed above the current market price. Okay, so it is placed above the current market price. So so buy stop is a trade that or an order that is placed above the current market price. Let's make it easier for us. Good. Okay, so now where is the current market price? Here's my current market price. So any price above this price, so it can be here, it can be here, it can also be above this yellow line, it can be here, but your buy stop must be a price above the current market price for a buy. Because if you don't do it that way, you put a buy stop there, it will show that your trade is invalid or your order is invalid, and it won't even allow you to place the order. So just to show you what we're doing, let's show you something close to that. Good. Chat. So okay, current So it's exactly what we did on the trading view. You see, you can do it here too, but trading view has more tools for you to work with. So let's say we want to place a buy stop, for example, and I told you buy stop has to be above the current market price. So let's see, buy stop, what is the current market price for the buy is what you have here. Now if you place 1705, okay, now this is a price below the current market price. You can see here you don't have, it's not valid for you to place the trade because that is an invalid order. But let's take it up and put 16, you can see it becomes active. All right, so here you can see that, okay, this is a current buy price, current market buy price. Now you can see your pending order is above the current market buy price. All right, so that is what it is. So what happens is this. Nope. Which brush? So what happens is, sorry, this is a little bit tricky. Okay, let's take it again. Okay, so what happens is this is current market price. Price goes here. Let's say this is where you want to place your new trade, your new this is where you want your okay, so let's say this is where you want to place, this is where you want price to get to for you to enter the market. Now there are two options. You can either wait for price to get here, then you enter market execution, or you can just place a pending order there, and when price gets there, it takes your order and keeps going up. That is if price goes up. All right, now all these you do after you have done your analysis. We haven't talked about anything on how to analyze your chart and all that. Then we're doing the basic things first of all, so that when it is time for you to place your orders, it is easy for you. So price gets here, like we said, picks your trade, and then goes up. If your prediction is right, you're making money. All right, so that's what your buy stop is. It gets here, takes your order, keeps going. All right, that's your buy stop. So price has to be above. This can be a lot of pain to delete. Okay, so we're done, and there is still one there. Okay, so let's talk about, we've talked about the buy stop. Let's talk about the buy limit. Okay, buy limit. The buy limit is an order that, what happened? Okay, your buy limit is an order that enables you buy below market price. Buy limit. Okay, what did we say that does? Okay. Buy limit is an order that is placed below current market price. Let's do what we did to the other one. Okay, so this is the second one. So we have two types of buy pending orders. Okay, so let's say you believe that now that price has gotten here, price is going to come lower before it goes to where you want to. Before, let's say you did your analysis and you believe price will come down here before going up. So if you feel that is the analysis that is going to happen, you feel okay, price is going to go here, for example, but this is current market price, this is where you take profit, or this is where you feel price is going, but then you believe that price will move down first of all before going up, making this kind of movement. Believe price will do this. Oops, wrong to curve. Okay, so you believe okay, so let's say you believe that price is going to okay, all right, so let's say you believe that price is going to come down first before going up. You believe price will come down here, then move up. Okay, let's say this is the movement that you believe price would do. Instead of you to wait for the markets to come all the way down before you now place, instead of you to be on your chart looking, okay, has price gotten there, checking all the time, you can place a limit order. So a limit order, a buy limit order, is an order that is placed below current market price. This is current market price is placed below current market price. So what if your prediction is right, the market will come down and then go up. All right, so let's check it out here, just like we did the buy stop. Now place buy limit. Now I told you the buy limit is placed below the current market price. You can see this price is above current market price. You can see here it won't work, okay, because at this time the price is above current market price. You use that for buy stop, not buy limit. But then let's see, the price we looked at here is 16667. So let's put 1666.7. You can see, you can then place the trade. You click on it, you can see that, and it is done. Okay, yeah, so that is that for that. Now let's talk about the sell part. Now a sell order is an order that you place predicting that the market is going to go down. All right, so if you're predicting that the market has gotten to a point where it should go down, then you're going to be placing a sell trade. But then if the current market price is not a price at which you want to sell, you can then use your pending orders. All right, so we'll talk about the sell stop first of all. Just like we talked about the buy stop, talked about the buy limit. Now let's talk about the sell stop. The sell stop is an order that is placed below the current price. Okay. So one thing you have to know is one thing you have to know about these orders. If it is a stop order is placed in the direction of the market you want to go. Okay, so for example, if the market is going up, your sell stop. Okay, if the market is going up, that means you're placing a buy stop. If you believe the market is going to go up, you're placing a buy stop. What that just means is price moves towards your order and continues in that direction. So your buy stop moves in the direction of your prediction, okay? But in the direction of your prediction, if it's however it's you feel the market is going to be coming down, then your sell stop also moves in the direction of your prediction. The market is going to come down. So market price is above, or market price is where it is, your stop will be below it, coming towards your direction. Market price is, or market direction is up. Your current price is here, so market moves in the direction, gets to your stop, and then continues. So you see it flows that way. But when it comes to the limit orders, what happens is market goes first of all against the direction you're going before going up. Okay, so it does something like a curve. Let's move this. Okay, so let's say you believe the market is going up. This is current market price here. Your pending order is here for the limit, so it's below. If you're buying, for example, so market is up, current market price comes down first of all, then goes in your direction. Same thing when you're selling. So the logic is just the same. When you're selling, you believe market is going to go down, but then it goes up first of all before coming down. Goes up first of all before coming down. So current market price is here, you believe market will come back up first of all before coming down. So the limit orders go, first of all, price goes against your direction, picks your order, then goes in your direction. Alright, so for example, we'll talk about the sell. Okay, we've talked about the sell stop. So let's do an example on that. So this current market price, but you believe that the market is set to drop down. You believe market is set to drop down, but then you think that price has to, let's say at this point, you believe that for this market to sell, it has to go below this level. It has to break this level first before it will continue selling. Then you can place your order below the current market price. So like I explained before, current market price, stop orders are placed in direction of the market, or the direction you feel the market is going. So trade gets here, and then market price gets here, and then picks your order, continues going down. If that is your prediction, if your prediction is right. Okay, so this is current market price. Now your sell stop will only work if the price is below the current market price. So let's see how that works. Price here is 1699. Okay, 1699, sell stop. So 1699, you can see it will allow you place that trade. Look at it here. This is current market price. You see your pending order below. And it has placed again. Okay. Sell stop below 1699, below current market price. So you can see price here, your pending order here, current market price here. So when price goes all the way down, it picks your trade and then goes in your direction. All right, so for the pending order, for the limit order for your sell pending order, the last one is the sell limit. And if you've been following what I'm saying, you already know what your sell limit is. The sell limit is an order that is placed above the current market price. Okay, so this is it. Yeah. So now this is current market price. If you believe that price has to come back here, for example, it's come back here before going down, then your pending order will be above. So it will be something like this. Okay. So the movement of your pending order will be like this. Okay, this is the current market price. First of all, current market price. First of all, it will move here. Let's use an arrow. So current market price, you believe it will move here first of all, then move down. So your pending sell limit order is placed above current market price. So the price we'll have here is 173421. Let's see, sell limit 1743. Now this price is above this, the current sell price. You can see above it, and you can see your place is active. You click on place to place the order. If you look here, you can see current market price and then your sell limit here. If you place it, then when price gets there, to pick your trade and then go in the direction that you want. So the last types of orders we'll talk about are the protective orders. Okay, now for the protective orders, for the protective orders, you have take profit and sell stop. So if you're buying, for example, that means you predict market is going to go up. So you predict market is going to go up, for example, and this is current market price, this is current market price. Now your stop loss will be below, okay, will be below the current market price, or be below where you're buying. So if you bought here, for example, your stop loss has to be below. What the stop loss does is it protects your capital. So for example, in Forex, you're taught to risk between 1 to 2% of your trading capital. So if you have $1,000, for example, as your trading capital, what you're expected to risk per trade is $10 to $20 per trade. So if you calculate the number of pips between your entry and then the stop loss price, it should be equal to that $10 or $20. So what happens is, you expected the price to go up, but then price decided to come down. What you're saying is, if it gets to this level, I do not want to be in the market anymore. The market should take me out. So it takes you out. Since you've calculated your stop loss and it's equal to $10 or $20, it takes you out in a loss of $10 to $20. But if you hadn't put the stop loss here, what happens is market will keep going down and you keep being in negative, in floating loss or negative, and if your account can't handle it, you can actually lose your $1,000. Okay, but then putting this here helps to protect your account. So you lose the $10 or $20, but then the balance of your account is safe for you to place other trades. Okay, so your take profit, on the other hand, is an order that protects your profit. Now your stop loss protects your capital, your take profit protects your profit. Okay, so if you believe that price is going to get, let's use another part of the chart. Okay, so for example, price, let's say price was here. So let's say this is where current price was. So let's say price was here, and then you're in a trade, you've entered your trade here, but you predict that price is going to go from here all the way here to this point. Okay, what you do is you can place your take profit at 1876.20. So when price gets there, it takes you out in that profit. Now if you don't have a take profit, what happens is price could get here, get to your target, and then come all the way back down, and then you don't really lose your profit, you also lose some part of, in fact it can go all the way down and hit your stop loss. If you don't have a stop loss, it can wipe out your whole account. Okay, but then if you had a take profit here, a target, then it helps protect that profit you've made and closes that trade for you. If you don't, it might take all your profit away, or it might still go up and give you more profit. So that's it. But it's good you trade with a stop loss. It's good you trade with a take profit. So your take profit is ahead of your current price. Is ahead. Your take profit is above. Is a price above your entry when you're buying. If you're selling, it is the price below your entry when you're selling. Your stop loss is a price below your entry if you're buying, and then it's a price above your entry if you're selling for protection. So we'll stop the class here today. We've talked about the pending orders, we talked about the protective orders. So let me know what you think in the comment section. And don't forget to subscribe. See you in our other classes. Bye for now.